Hello, everyone. This is Realtor Linda Peltz. Today, I'm here with Garrett Wood from Nexa Mortgage, and he's going to tell you all about how the mortgage industry works with his company. Take it away, Garrett.
Excellent. And thanks for the introduction. We were just kind of discussing in the background what our focus is at Nexa Mortgage and kind of how we're different and really being a game changer in this market where things are a little bit shaky and clients have different viewpoints on what the market looks like ahead. But with data, we're using that in a lot of ways. Let's focus on the first way we're using data right now in this market. And that is to leverage loan programs to build wealth, which is a sentence that is commonly kind of misconceived and can mean a lot of different things, but it's very simple, right? When you have a mortgage, there's two expenses of your mortgage. You've got interest, and then you've got your mortgage insurance. And so, what is oftentimes overlooked is the fact that over 15 years, you've actually spent $380,000 on interest and mortgage insurance in this example, right? And so we use this thing called a total cost analysis in order to lay this out for our client and say, hey, what is your goal? Is it to build wealth? Are you going to refinance in 5 years? The shocking statistics says only 25% of home buyers actually refinance, which is very low. So that means that what I'm coaching my clients is as of today, in the context of they're going to have this loan for 15 or 30 years, what makes the most sense for them? And that is why I'm really grateful to be able to offer this experience in the sense of let's look at conventional versus FHA. Let's look at the savings over 60 months. In this example, a conventional loan would amount to about $10,000 in savings for our client over a 60-month period, which is huge. And this is in a form that a consumer or a client can understand. It's simple. We're not making this more complicated than it is. If you choose a conventional loan over an FHA in this situation, you would save around $10,000. Now, you see on the right here, there's two buy down scenarios. And right now, seller paid buy downs are very hot. And there's a lot of
Very
different,
popular right now in this
right,
market. I
right,
agree.
right. Right, and there's a lot of different talk about them, and we have the 2-1 buy down and the 3-2-1 buy down, but the reality is the buy down might be good for you, it might not be good for you. You may want to use that money for your closing cost, but in this scenario, we do have those options side by side because you would save a little bit more money by using a buy down in those first 2 years, as opposed to not using a buy down. But when we zoom out and look at the big picture, you can also see that over 15 years, how the buy down affects your loan. You would still save a little bit more in interest and mortgage insurance from doing the buy down. So again, this is one part of how we're using data to really guide our clients through this process and make it clear for them to understand what loan program makes the most sense. Um, One other thing that Linda, I want to kind of show you and talk to you about is interest rates, which is a hot topic of discussion right now. We take pride in offering wholesale interest rates. And so you can see this is priced out for a borrower with a 650 credit score. Let's go to the search fields here so we can all be on the same page. 650 FICO. Just a very basic borrower here. $250,000 purchase price. Now, this is on a conventional loan. We can offer a 5.9% as of today. So this would be for a Home One program, which is similar to Home Ready, Home Possible, those type of programs. So it just does have an AMI or an area media income limit for this program. But you can see that these are very competitive interest rates, 5.9% on a conventional loan as of today. FHA, we can do 5.75%. And that is without any income limits or without following under a certain criteria for FHA. That's just a regular FHA loan. Let's see.
I
How,
don't
how
think
does
they
this look to you,
realize
Linda?
how a lot of times the clients don't necessarily realize that it varies, right? And it does depend on so many factors. It's not just a straight, oh, hey, I can give you this percent, right? It depends on their credit score. It depends on their debt to income ratio. There's a lot of determining factors. And then these are the mortgage companies that you offer. So it's amazing that you guys can even kind of somewhat get close when you're doing this for these individual clients.
Right. Yeah, you're exactly right. There's a lot of different factors, and I think to make it easy to understand, there's what we call loan level pricing adjustments. And if your credit score is, 620 to 639, you will have a certain interest rate. And if it's above that, you will have another interest rate. Say the next cap is at 680. And so those loan level pricing adjustments are applied to your loan and your interest rate. And that's why we would start at a base rate. Say the base rate was 5.5, we would add a pricing adjustment of a point or something along those lines, and then that's how we get to this final interest rate. But I would say for all of the potential home buyers out there, when you focus on credit, I'm not a credit expert, I'm a mortgage advisor, but just try to get above 620. And that is because at that 620 threshold, you will qualify for much more than you would if you were in that bracket of 580 to 620. Because a lot of times people say, all you need is a 580 credit score to buy a home. That's true. It's very true. But if you want to have the best possible loan, and not have to refinance within just a few years, get above 620 before you make that decision. Um, any questions about that stuff?
Well, I think this is a wonderful explanation on uh, getting over to the client and having them understand that you can have two individuals sitting there, and there's so many factors that have to be factored in that you're going to be quoting a different rate for each one just because of the different factors in their background. So I think that's a wonderful explanation of how you determine which is the best way to go for these clients when once you talk to them. And that's what's so important. You be honest with these lenders, people. When you're trying to get a mortgage, they have certain criteria that they have to meet, and they don't want to overpromise. So you have to make sure you're honest with them and get them the information they need in order to be upfront with all the variable factors that go into these loans. I think that's so important for them to understand that.
Right. You're exactly right, Linda. And then there's the whole other topic of down payment assistance and things along those lines. When we have small or minor issues with our credit, and then you also want to use something like down payment assistance, keep in mind that your interest rate will automatically be a little bit higher for using a down payment assistance program. And then if you were in that lower threshold of your credit, 580 to 620, now you're going to be even a little bit less. Right. So come in with a strong credit score, especially if you're looking at using some sort of down payment assistance. And let's just jump into that subject while we're on it. We do offer many types of down payment assistance here, ranging from 3.5% coverage all the way up to 5%, meaning that we could actually cover your 3.5% down payment as well as that extra 1.5 for your closing costs, or the extra one for your closing costs if you decided to use those programs. So we want to make that
Right.
available. It is in the form of a forgivable grant or repayable. And those comes with different terms and different rates as well for those two programs. So let me just price one out while we're kind of live here, um, and we can see, you can see my screen, correct?
Yes.
Okay, cool. Just bear with me 1 second here. So Linda, is down payment assistance something that your clients often ask about, or is it a
A lot
topic
of
that is
the
relevant?
first time home buyers do. Yes. A lot of the first time at least want to understand how it's going to work. And of course, then once you tell them, well, nothing's free. Yes, you can have it, but it comes at a cost. A lot of times it's interesting, they opt not to accept it, right? Versus the extra cost that it's going to be, once you break it down for them. So
Right.
yes, a lot of the first times ask for it, but not all of them do accept it once they see the difference in the cost.
Right. And that's another very important piece to understand. And when we break that down even a little bit further, typically when you do a loan with me, Garrett Wood at Nexa Mortgage, I don't charge any origination fees. So we get paid from the lender of the loan. Just being transparent, our compensation comes from them rather than the borrower, rather than the client. However, when you do something like down payment assistance, now we're required to charge an origination fee, us,
Hmm.
the mortgage loan originator. And so you would actually have the net of the origination fee minus the assistance. And that would be what you're actually getting assisted with. Because typically, once again, you wouldn't have an origination fee, but if you did down payment assistance, you will. And so
Hmm.
you're going to have to pay a little bit more, 1.5% extra for that origination fee. And that's another reason why down payment assistance is talked about, but not used as frequently, as it's talked
Exactly. Yeah.
about.
It's out in the public. Oh, we have all these programs available. They don't really tell, oh yeah, but they come at a cost, yeah, they're available, but they're not free. So
Right.
I think
Exactly.
that's
So
where
here
I
we are
think a
in
lot of
in
times we have to get it across to our buyers is there's nothing free. So yes, it's available, but
right. You're exactly right. Nothing is free. Here's kind of a sneak peek inside of one of our lenders' portals. And today they are offering a special. They do this often. If we see here, where my mouse is hovering over, we have a program called Boost Down Payment Assistance. It is a repayable form of down payment assistance. However, the lender is actually offering a $7,600 credit to use this program today. And
nice.
so, right. So if you were to say, I'm fine with the 7.5% interest rate to start my loan, knowing I can refinance, whenever the time may be, I'll take a $7,600 credit along with the down payment assistance in this circumstance. And so you can see there's tiers to this. You can accept a $2,000 credit or a 6.75% interest rate. So we could get a little bit lower there. And this is common to what down payment assistance looks like with us. We do offer these different types of programs. Now, say you didn't want to do the boost down payment assistance, what else is there? We've got forgivable programs where you're not repaying anything. It's just given as a straight grant. Now, the downside to something like that is you would pay $1,700 to lock your interest rate for 30 days. So now you do have a cost associated with that down payment assistance because it's forgivable. Um, but again, I think there is value and benefit to this if that's really what is needed for our particular client in that moment. If you're really having
Hmm.
trouble coming up with those closing costs, you want to look into something like this, and we could definitely assist you
Definitely.
with that.
And that's there again where it comes in. You can have two people sitting there, but they're going to be very different assistance needed or very different types of loans and interest rates. And it's so variable depending on what's in your history, what's in your background. Being a realtor, it's kind of straightforward. Once we get them past you lenders, right? We know exactly what we're spending, but getting to that point, it's quite the little scenario that you got to get them through, and there's many different steps to get them to the point where you get it to us realtors and say, okay, they are pre-approved for 325,000. That's pretty straightforward for me. So you have a lot on your plate trying to get these people through the systems and getting them, my goal is to make sure they understand, right, what they're getting into and what's going to happen in the future. So um, that's a lot on your plate, just trying to get them through there to get them to that understanding.
Right. Sure. And what's important is that we're all three on the same page. And whether that
Exactly.
means we're meeting together, or whether that means we're even on a three-way phone call, something as simple as that. That way we
That
all
is so true.
understand. Right. That way we all understand what's going on. And if there's additional documentation that's needed, the realtor is going to be aware of that as well. And maybe, she could even give you a call herself. So we're all three going to be working together in unison when we do something like this, especially when there's down payment assistance involved, because, there's a home buyer course you need to take. And maybe the realtor's more familiar
Mhm.
with that. Things like that that come up that we can all three work
Well,
together
even
on.
just writing the offers, a lot of times, I'll be on a three-way call, trying to write the offer up to meet your criteria that will help the buyer in the
Right.
transaction. So it's a definite team effort here to get these clients into their homes. And it's so important to have wonderful communication with the lender. Just because they did their part and got them that pre-approval, their job doesn't stop. We as lenders need you, and you need us to get that transaction closed. It takes all of us.
Right. You're exactly right, Linda. Um, Now, what I want to go over here, just take a few minutes of your time. This is more so for realtors in the profession, whether you're in real estate in some way, shape, or form. Before I start this, I do not want to take full credit for this. This data I've sourced from Barry Abib, who's a mortgage expert, and I put this together based on his pinpoints. Of course, but this is something that needs to be talked about more often, and the literacy needs to be spread among realtors, even prospects. If you're interested in real estate at all, it's important to know what's going on with our interest rates, right? And with the topic of interest rates, we have to talk about inflation. Inflation is simply supply and demand. 3 months ago, we saw that things were not on the shelves. There was a lot less supply than there was demand. That's starting to improve, and that's really what we call inflation. That supply and demand kind of tug of war. Um, the problem is, how do you measure inflation, right? What really is the measure of inflation is called the CPI, or the core consumer price index. So if we were to say, how do we measure supply and demand? How do we measure inflation? Is something called the CPI. What makes up the CPI though? Is it literally goods go on the shelves that are flying away? No, it's actually shelter costs makes up the largest portion of the CPI. So what more specifically, what does that mean, shelter costs? They actually look at rent. So we're going to look at the year over year monthly increase in rent in this slide here. And what I want to illustrate is that shelter costs are coming down. Linda,
Mm,
you can remember back in September, November of 2021, uh, prices were through the roof. You know, Rent prices were even through the roof as well. And we saw an 18% year over year increase in shelter at that point in time. Now, based on this graph and based on this data here, in September of 22, it was only 7.5% year over year increase, meaning that things are coming down, right? We see things coming down. They're starting to improve a little bit as far as these home prices. Um, the problem, however, is that the CPI, or the core consumer price index, did not reflect that, meaning that
mhm.
inflation did not reflect that. So here on this slide, we have a roller coaster showing it. In the CPI, shelter is way in the back. It's saying that it's still going up. The CPI shows that the shelter costs are still increasing. In January, we were at this pinnacle here, and
Right.
now we're coming down. The real shelter costs are at this guy in the front in the blue shirt. He's coming down the roller coaster. So the Fed right now has its eyes in the rearview mirror, and numerically, the CPI has not reflected the decrease in the shelter costs. In summary,
Hmm.
so that's kind of step one. Now, this is our Fed chair, Jerome Powell. He says we now understand how little we know about inflation. That was Jerome Powell. And so what we have here says that the Fed hikes lead to recessions. We saw several Fed rate hikes. We saw too many to count. The Fed funds rate keeps getting hiked. That is what you all see on the news, by the way, when you see Fox, CNBC. The rate hike refers to the Fed funds rate. That doesn't necessarily relate to mortgage rates, by the way, which is a common misconception as well. So there's a
Hmm.
lot of fear that's being spread around. We know that as well. So here we show that there is a lot of rate hikes in the recent past. If we look at, 2020 was the last recession, declared recession. At the start of COVID, there was that mini recession there that was declared. Um, and so my point is that we are either in a recession that's not declared, or we're about to be in one. You know, the Fed has not yet declared economic recession. They look poor if they were to do that, right? I think that that's pretty
Right.
clear. However, when we look at data, which is what everything should be based on, is data. We're clearly in a recession or about to be in one. So this is showing you that inversions lead to recessions. We have something called a yield curve. An inverted yield curve just means that short-term bonds are paying more than long-term bonds. Um, there's 2-year treasury bonds, there's 10-year treasury bonds. So to make it more simplistic, the short-term investments are paying more than the long-term investments, which is crazy, right? That's called an
Mhm.
inverted yield curve. If you were to buy a stock today, the short-term stocks are paying more than the long-term. That's an inverted yield curve. Right now, we have an inverted yield curve because of the current economic situation. Definitely have an inverted yield curve. So that's another indicator we may have a recession. Unemployment rates when unemployment rates are at their lowest, we see recessions as well, right? We look at the graph here. Um, this is insane because we have unemployment rates lowest of all time in 50 years. That was in 2022, December of
Mhm.
2022, roughly. We had a 3.5% unemployment rate.
Isn't that
Um,
crazy?
Crazy. It's crazy. And so here we are with this chart. It shows you the unemployment rates, and then how quickly from that lowest unemployment rate we saw a recession. That's what this is illustrating here. In February of 2020, it was the same month. Unemployment rates hit the lowest point of 3.5%. That same month, there was a recession, a declared recession by the Fed. So going back in many, many years, we can see that as well. Whenever we get to that lowest unemployment rate, there's the recession shortly thereafter. Um, Now, here's kind of the summary of this whole analysis is that recessions lead to lower mortgage rates. So, yes, I am predicting, if you will, that mortgage rates are going to continue to come down, and we have seen them come down already from where they were 3 weeks ago, 4 weeks ago, because that CPI number, which is actually making its way more and more on the news, is showing that inflation is improving. Reason being, shelter costs are starting to reflect more accurately. We see those rent costs starting to come down a little bit, and it's going to continue to come down because that has not caught up with itself. And a lot of these indicators show us, that there's likely going to be a recession if we're not already in one that is not declared. So this just sums it up. Back in 2020, um, when we had that small recession from COVID, rates went from 3.75 to 2.75. That was an interesting time. That's all I can say
Mhm.
there. Um, I think we all learned a lot from that. We're all learning a lot from this economy, and that was really what I wanted to show you here. Um, just that there's a lot of things to keep in mind when you're buying a home, and timing interest rates is something that some people focus on and others don't. If you're a buyer, I would say that right now we know that rates have improved from where they were a month ago, and we cannot guarantee that they're going to improve. Data suggests that they may, but buying a home is the best time when it's right for you, you know?
You're right.
And that's even if rates were 3%, I have the same answer as they were if they're 7%, because buying a home is specific to each person. And we're trying to capitalize on the equity in the home. You can always refinance. And keep in mind, as when you refinance, there's really no cost associated other than your appraisal that are out of pocket. We're taking equity out of your home, and that is your cost at that time when you refinance. So keep those things in mind. Interest rates are a whole nother topic of discussion, but I hope that that was informative, in that context.
Definitely, definitely. And from a realtor's standpoint, so much easier to get clients the buyers into a home with a seller when the interest rates are a little higher. Now, when the interest rates are a lot lower, they're going to be fighting other buyers to get into these homes, and they're not going to have near the choice on the home. So yes, buy the home when the interest rate's a little bit higher and then just refinance when the interest rate goes down, but you're already in your dream home. Whereas if you wait till that interest rate goes down, you're going to be fighting all these buyers for homes, and you're not going to get in your dream home. You're just going to have to take whichever one you can get into at that point. So it's a huge difference in the way the real estate market too works also.
Right. You're exactly right. And the moments you're going to have in that home are not worth a few points of the interest rate. And it's like
Mhm.
you can't really feel that until you feel it. But that's really the truth. And um, a home means a lot more to us than just a place to live. It's where we
Right.
experience our whole life. It's where we have children, and we see them grow, and we learn things from them. And all of that is taking place in a certain environment. And that's why I actually got into mortgages and real estate, because, I felt that, and I want to help people do this the right way. And so, once again, leveraging your loan program to build wealth while you're having those moments is really a duality that can't be beat, anywhere, any way else. And so, um, don't try to wait out for an interest rate when you see a home that you could be having a good time with your family. That is the way
Definitely.
that this works. Our job, my job, Linda's job, is to guide you in the right direction based on what you want and need. And that's it. You know.
Correct. Correct. Well, that was a wonderful information. Do you have anything else you would like to share before you jump off here? And
I
make sure
don't,
you
Linda,
give
but
them give your information out so they know how to contact you. And I'll also put it in the description and articles for them too. So
okay, excellent. Yeah, call, text my phone number. This is my business number. It is 434-484-2022. My name is Garrett Wood, two R's, two T's, over at Nexa Mortgage. Um, if this is of value or benefit to you, please reach out to me via email that Linda is going to post there in the chat. And I look forward to helping you or your family or friend with this purchase. And Linda will be doing the same.
wonderful. Everybody have a tremendous day today, and we will catch you on the next one. This is Realtor Linda Peltz, and we will get all that information to you down in the description. Have a wonderful day, everyone.
Great.